Well, for more on the markets, joining us now is David Waddell, CEO and Chief Investment Strategist at Waddell Associates. Thanks so much for making time for us today, David.
Thank you for having me.
So we have seen, not today so much, it's a bit of a muted trading day today, but recently we have seen equity markets rallying, particularly through the month of November. What do you see as the big catalysts that were behind the somewhat shift in sentiment when it came to how investors were feeling these days? I'm wondering if it just comes down to the expectations around interest rates.
Well, I think after years of distortion, because quantitative easing distorted rates, and then we fought to try and find normalized levels, we've gotten there. So I think the 10-year should be 4%, and that's where we are. And then as people look into 2024, something significant has changed, which is that there will be aggregate earnings in the S&P 500, and more so even in the small caps and mid caps. So we didn't have any earnings at the aggregate level to speak of in 2023. So it was really just a sentiment-driven market. 2024 gets more fundamental. And I think as strategists start doing their homework, they realize, oh my goodness, we got earnings again. And that ends up, being a pretty good backdrop to make investment decisions.
Do you think that those earnings will be impressive next year? And I know that's speaking very broadly and painting everything with one brush, but or do you think that there could be some surprises when you start getting down to those fundamentals?
So in my head, 2024 sort of takes us back to normal, right? So if GDP goes back to normal, we get 1.5% to 2% GDP growth. If inflation goes back to normal, you get to 2 to 2.5%. And so that means nominal GDP grows around 4.5%. That's normal. That'd be fine for revenue growth. Then the question is, do you actually get margin expansion? I think the advent of the investments in technology will add margin. I think obviously input costs coming down will add margin. I think softening in the labor market will add margin. Interest rates coming down will add margin. So I think you can take that 4%, add a little margin on top of it, and there's no reason earnings couldn't be up 7.5% or more next year. And so that becomes baseline if you're trying to figure out what your year-end target is for next year. So that's very positive.
Interesting. Okay, so do you think overall then next year will be a positive year for equity markets?
I do, and it comes down to how effective companies are at utilizing the technology on offer. We won't know how quickly the adoption rate moves, but I imagine it moves pretty quickly. So I'm a believer in AI. I'm a believer in the addition to earnings that ultimately will come from it. I was not a believer in, social media. I was a believer in the internet. If you go back and look at productivity and earnings growth in the late 90s, it was really robust. I think we're back in that cycle, and we've really just begun. So I think most likely earnings surprise to the upside.
So can markets, outperform in that sort of way if we're also facing such macroeconomic uncertainty that, there's a lot of talk about the possibility of a recession, although there's also a lot of talk about a possibility of a soft landing, that kind of Goldilocks scenario, particularly in the U.S. But with that hanging over things, how do you, take that into consideration?
I mean, markets climb a wall of worry. So if we weren't worried, I'd be super worried. So the fact that we're worried about the recession, et cetera, I see as a positive. We've been dragging that carcass around now for a couple of years, and it really hadn't hit. It actually did hit in 2001 in the first 2 quarters. It's just nobody really counts it. So looking into the economy next year, earnings are growing. So I don't really see any reason for companies to lay off a bunch of workers. The Fed will cut rates. It's a question of when. I know the markets were thinking March this morning. Maybe it's May, maybe it's later. I don't know. But if inflation's 2.5%, they're not going to be at 5.5%. So you're going to get rate cuts. That'll be additive. That'll loosen financial conditions. So I don't see any real reason for this market to just fall into a ditch through, some sort of recession. And I think the soft landing definition really is that inflation comes down without unemployment going up. And that's been occurring. So the Fed's done a good job through this cycle. We got a soft JOLTS number this morning. If we get a soft and employment number on Friday, then you're going to talk a little bit more about the timing of rate cuts. And so the Fed will have to come to the rescue because they've won on inflation. Now they have to win on employment.
Well, there have been some, announcements of layoffs. I'm thinking of just Spotify yesterday, but others as well, Amazon too. It's kind of added up over the past couple of months. How do you view that then? Are those companies that are, cutting jobs, perhaps they overhired during the pandemic and, really ramped things up? Or are those companies that are cutting and preparing for the possibility of uncertainty?
Well, it's interesting. So the continuing claims number is back to 2 million. That's pretty high. But the weekly unemployment claims number hasn't really been that high. So it's less that they're laying people off across the economy and more that they're not hiring them as much. And I think that's what the JOLTS data showed us this morning, right? We were expecting 9.3 million and we got 8.7 million. That's a pretty big delta. So I think companies aren't necessarily firing across the economy as much as they've just stopped hiring as robustly. And to your point, they had to scale up operations and employment to meet elevated levels of demand. Those are now normalizing, so they're normalizing headcount as well, which also puts downward pressures on wages, which is good for corporate earnings.